I asked ChatGPT to give me a few different investment strategies that I could talk about in the coming videos for Washington State employees, and it spat out over 40 different investment strategies, some of which I'm not really familiar with, but I think I understand what it's trying to get at. So just want to make a quick video today to go through these investment options. And no, it didn't actually give me things that are only for Washington State employees, but hey, we're going to go through all 40 of them because I know a lot of people ask what they could be doing in different situations. So, and also categorizing them for them. So let's start here. Conservative strategies. First one has this high yield savings account. If at this point you still have money in a traditional savings account that isn't high yield, you're just flat out losing money, and it doesn't make any sense to really stay in them. If you think about it, a traditional savings account and a high yield savings account, the only difference between them when you get down to it is the amount of interest that gets paid. So if traditional interest accounts, I actually just Googled it right here. Currently, as of according to this, January 14th, it pays 0.42%. So if you have $10,000 in there, it's $42 a year in interest. Whereas if you got a high yield savings account, you see it's saying 4.5% to 5%. So if you look at the difference, you're earning about 4% more on average. 4% on $10,000 is now $400. Now it's not life-changing money, but it's a lot better than $42. $400 you can do a lot with. You can go on dates more, invest it. There's a lot of things you could do with that extra $400. That's just 1 year with $10,000. What if you had $50,000 in the savings account? Then you'd be looking at $2,000. What if you didn't touch that for 10 years? Now you have $20,000 in that case. So high yield savings accounts pay a lot better than traditional savings accounts. So at this point, if you're not using them, highly recommend that you use them. If you're just using like the local bank, you're probably not in one. Most brick and mortar locations aren't going to have a high yield savings accounts. If you think you're in one, you really want to double check just to make sure, because you literally could be losing out on thousands of dollars if you're not in the right one. Second one, CDs. Never really a big fan of these, but I know a lot of people like to use them. You know, they're safe. You invest, you have a certain period of time, you get interest, yada, yada, yada. Most people understand what a CD is. I'm not a big fan of them just because, well, for one, I'm young and I know that I can get fixed yields that pay better than CDs in other places. So I personally don't use CDs or ever recommend them, but I do have a lot of clients that like them and do have them. So that's another safe alternative to them. So it is another conservative investment option you can have. Number 3, Treasury bonds or T-bills. Now this one I don't mind. It is basically risk-free because it's backed by the U.S. government. I actually use this in a lot of our investment portfolios because they do pay, at least recently, a decent amount of interest. They pay better than a lot of bonds do. So last year I actually moved my clients out of a lot of the riskier high yield bonds and instead swapped them for T-bills. So I got something that was essentially risk-free. So I went to a safer investment, but I was able to earn the clients more yield just from buying up these T-bills. Strategy number 4 is a buffer ETF. Now, a lot of people don't know about this investment option at all. I don't see anyone online ever talk about it. A buffer ETF. So I don't want to go too long on this topic here, but essentially what you're getting at here with a buffer ETF is you're going to be in a fund that's going to track the market, but you're going to have a cap on the gain and you're going to have something that limits your losses. So basically, let's say you got a buffer ETF, they're going to protect you from a certain range of losses. So let's say it's a minus 20% and the cap is 10. What that means is you can invest in the market. If it goes up to anywhere between 0 and 10%, you get to keep that growth as interest. If it goes above the cap, you're capped. You only get 10%. So the best you could do is the cap for that year. Now the buffer part comes in is if you had a correction. So let's say 1 year from now, the market ended down 15%. If you had a 20% buffer, because your losses were between 0 and negative 20, the company actually chews up or eats losses for you. You get that money credited back to your account. So your total losses with the year are 0. So it's a way to invest in the market, take on some risk, earn a little bit of interest when the market goes up, but have some protection when the market goes down. Now, if you blow through that buffer, let's say the market tanks 30%. Depends on which ETF you're in, what the fine print says, but most of them are going to eat up the first 20% losses for you. So if we lost 30%, they would credit me back 20%, I'd be down 10%. So I still lost money, but I lost less than I would have if I was fully invested in the market. So that's just buffer ETF kind of in a nutshell. I have a few clients that use these, replaced a few annuities with these because they're a fraction of the cost. They don't lock you up. The money's liquid. You don't have to lock your money up for 5-7 years and have surrender charges on them. So buffer ETFs are kind of the new wave that's coming out. It's a great option for conservative investing. Option number 5, target date funds. I wouldn't count this as a conservative option per se. Not a big fan of these at all. Don't ever use them. Personally, don't ever recommend them. Our system that gives advice never uses them either. While they're maybe easy and convenient and it's the default for a lot of options, they just aren't personalized enough. They don't produce superior gains for other strategies. For people that are young, 20s, 30s, 40s, they're probably not giving you enough market exposure in your early years. You have bonds and you're like, if I'm 20, why do I have 20% in bonds? Yeah, target date funds really cost people a lot of money, and they've been sued multiple times because of this. On the flip side, as you close retirement, they're supposed to sell off. In some cases, they actually have more risk than people realize. So like in 2020, the safe funds, the 2020 target funds still dropped like 15%. So they're not necessarily safe by any means at that point. If I was retiring in 2020 and couldn't afford to lose 15%, I definitely wouldn't be in a target date fund. I would have the cash I needed actually in cash. That is, so I know it's actually safe. So that's targeted funds. Now it's giving me moderate strategies. All right, so diversified mutual funds, ETFs. They're, for the most part, going to be the same thing. I personally use ETFs, which are mutual funds. ETFs will process transactions right away. So a client calls me up at 10 a.m., says, hey, I need money out for whatever. I can go in and sell money to get sold at that point at that current price. We still have to wait for the money to settle. It's trade plus one. So within 2 days, money's available, can transfer them. Mutual funds, I have to wait until, even though I put the sell order in, it doesn't sell to the end of the day. So theoretically, if the market was going down that day, if I would have went at 10 a.m., I would have got a better sale price. Then the end, you kind of lose that money there. So some people think it's a big deal. I'm really kind of different on it, but I just like being able to transact, know it's done. Also, it's just a little bit more efficient from a tax standpoint. So if these are being held in a non-retirement account, ETFs don't have as much turnover, therefore they're more tax efficient. All in all you're really doing is buying different stocks and bonds across different asset classes. So instead of you going and buying, 30 or 50 different stock companies, you buy a few ETFs and you have probably a couple hundred stocks that you have exposure to now. Dividend growth investing. So this is when you invest in companies that pay out dividends. Personally, not a big fan of dividends. I don't think a lot of people understand what a dividend is. A dividend is really just a forced distribution, right? So if I have a stock, let's say it's Apple, and they're going to pay a 5% dividend, what really happens is the stock goes from $100 down to $95 in value. So the dividend they pay out, the 5% they pay out, you might get it in your pocket, but your stock also went down 5%. So what you really have now is $95 per share in stock and that 5% in cash sitting in your account. So it's a forced distribution. I'm not a real big fan of dividend investing per se, of just like buying a bunch of stuff just to reap the dividends. It's kind of a wash at the end of the day because it's really the same value. They're just forcing the gains or withdrawals upon you. Real estate investment trusts, don't personally use most of these. I have some clients that have them. They're tough to get out of. Great investments if you're going for the long run and don't mind having illiquid money. Basically, you're investing in real estate. They have dividend payouts. These are usually long-term contracts, 5-10 years or more. There might be some shorter. Those are the ones that I've typically seen. They average, 8-10% a year, a lot of them, but not my cup of tea. I like having money a little bit more liquid, especially there with my clients. So if we needed to make a move or something happened, we could get out of them. If you're in one of these and the market would turn on you, let's say they bought a mall and the mall shut down, you could lose money on it. So these real estate investment trusts invest in all real estate, not just housing. It can be also commercial. So there are some risk inside of them. Municipal bonds, I don't know if I've ever seen these. They provide tax-free income because you're investing in state or local governments, but for the most part, they just don't pay that much. So they kind of have fallen out of favor and a lot of people don't use them. The income that does generate that is tax-free. You could probably earn more in a different bond even after paying taxes to the government. So municipal bonds, still a strategy to consider, but unless you're ultra wealthy or the other bonds aren't performing, this isn't something that I typically see a lot of. All right, balanced portfolios, equities and fixed income. This is what most people would use. This is like the whole 60-40 portfolio thing. Yeah, I guess you call it a moderate strategy. So it all depends on how much you have in equity versus fixed. There's a lot of people that, even if you have an advisor, they have predetermined rates where this is my 60-40 portfolio, this is my 70-30 portfolio. They can work. If you're just kind of using it to grow or hold your money, not bad. If you're using it for income, I probably would recommend a little more personal approach. You want to be a little mindful of what is in the fixed income. Having 60-40% and you're trying to take 4% out of your 5% out a year, you might be having too much in fixed income and you're not going to be able to replace what you're taking out. You might need to shift more into equities. So if you're just kind of holding it, not bad. If you're using it for income, I wouldn't really use this typical strategy here. Now let's go to the aggressive strategies. So we have growth stocks, so ones that go above and beyond. So if you get growth stocks are all good. Dave Ramsey talks about them. That's what we use in some of our portfolios. Sector-specific ETFs, I'm a big fan of these ones. So I know like our portfolios, we do have, not tech per se. We used to have healthcare. Now we're using more commodities, more oil, even gold per se. So if you can find the right niche or right area that is growing, they can be well. But if you invest in a tech ETF and something happened, you could lose a lot of money. So they do carry more risk rather on the aggressive side, but they can be good, right? So remember with aggressive, the more risk you take, the more reward you could potentially get. Keyword is potential, nothing's guaranteed. Now it's got crypto. And honestly, crypto probably has 40 of its own investment strategies within them. Crypto is not just these coins that a lot of people think are made up, have no value, you can buy and sell. I mean, sure, there's some of that, but the more established ones actually do have a tremendous amount of value. Crypto market is over $3 trillion. Now, anything that's a fad or fake probably wouldn't be valued at over $3 trillion. And it's been around for about 15 years. So if it was a fad or fake, whatever, it probably would have gone away by now. The fact that it's still here, still going strong, it's probably be around to stay. And really, when you dig into it, it's the blockchain that behind it all. It's really a technology thing. It's not so much the currencies itself, it's the technology and the opportunities it unlocks for people. That's really what it's at. So not investing in crypto or not believing in crypto is the same as I don't believe in the internet in like 95. Eventually, at some point, the internet we know today dominates everything. Most people use it. And crypto is still early, but in a few decades from now, everyone's going to be using crypto in some way or form. All right? Even if you don't directly use it, things are going to be based on blockchains. All right, so no new social media is coming out. A lot of them are built on blockchains. So like with the whole TikTok ban that's been talking about, if it was on a blockchain where a company like TikTok didn't actually own the platform, instead it was just users uploading the content and they own their own content and they just kind of shared it locally onto one server, that's decentralized finance. Or that's also done on the blockchain. So that's the future, what they call Web3. That's really what's coming out. So if you see anything with Web3, that's all crypto. Crypto also allows you to lend money, borrow money, stake money, farm, generate yield from liquidity pools. So there's tons of different strategies. I can probably make a whole video on that on its own. Just know that crypto is a lot more than meets the eye. And thinking that it's not worth anything because you can't buy and reward assets is the same as saying if I went to the back here and grabbed some Canadian dollars, went down to the store and tried to pay the Canadian money, they said, hey, we can't take this. Doesn't mean the Canadian dollar doesn't have any value. It's just not in the right form. I have to go and convert it into US dollars to pay for it. Just like you have all these stocks. If you want to go pay with a stock certificate, they aren't going to take that either. You got to sell the stock to get the US dollar to make it. Same with crypto. If I have Bitcoin, I have to sell the Bitcoin for US dollars, then I can pay for it. Right? So it's not all different than what people think it is. Number 14, small cap stocks. So these are smaller companies, more growth potential. I like this a lot. It usually has a better growth rate over the long run than a lot of the large cap funds. So this is something that a lot of my portfolios will have some exposure to. Leverage ETFs. I guess that's one strategy. I never realized you could leverage an ETF per se. Basically, anytime you're leveraging, you're really borrowing money. So if I wanted to put $100 into this ETF, I could leverage it at, let's say, a 2x. So I put in 100, they loan me $100, now I have $200 in there. The thought is if this thing appreciates by 10%, I would make $20 on the investment instead of just $10 if I only had my $100 in there. So I could theoretically sell it, grab my $20, repay back the loan. I'm still left with my gain. So it's a way to make more money. Very high risk because you can be liquidated. They could call back the loan. That's part of what happened during the Great Depression would set it off. People were trading on margin. So I don't know where you'd find this per se in the traditional markets, and I probably wouldn't use it myself. Just too much risk. All right, alternates, annuities, something you can invest into, generates income for life. Love these things. Pretty much everyone in America has an annuity, even though they don't realize it. So Social Security, what is it? It's where you fund it. It pays guaranteed income for life. It's an annuity. Pensions are annuities. Something that you funded pays guaranteed income for life. They just changed the name to pension security, so it's less scary. But when you dig down underneath the shell, they're all annuities. So like them or hate them, you've probably got them and are relying on for some portion of your retirement. Now, you can buy annuities. So if you want to convert some of your retirement assets or savings into another fixed income stream, that's where annuities kind of play. So you can buy them income for life. You can also use them for growth. So if you like an alternative to CD, some people will buy what they call them index annuities, just like the buffer ETF we went over earlier. You put the money in there. If the market goes up, you get some growth. The market falls, you lose nothing. They actually have a buffer that's what they call 100%. So there is no losses in a down market, and there's no fees on those ones. So I like those better than CDs just because, while it's not a guaranteed rate of return, not FDIC insured per se, the fact that I can gain market exposure and be protected from losses, I'm pretty sure I could average more than the 3-4% the CD would pay. So those are good options here too. Now, private equity venture capital, most of us don't have enough money to get into this whole private or venture capital area. So I don't know why it gave us that per se. So we'll just skip over that one. 18, hedge funds. They're the ones that manage a lot of the real complex strategies and stuff. We don't have enough to be invested into hedge funds. So we'll skip that one too. Gold and precious metals. So a lot of people like to make the argument of having physical gold versus just investing in it. All my clients, we invest in gold currently in the portfolio. We invest in gold miners and just straight up gold. When we don't hold physical gold as an investment firm, we don't. I have clients that do own it. Personally, I'm not real big on holding physical gold. I just don't see it as all that useful. Yes, it's tangible, but at the end of the day, if I went down to the store to go pay with it, I gotta like cut a piece of it off and give it to them. And if the whole market collapsed, is gold really going to have value, or is services that I can provide going to be more valuable? So if we're going to barter with something, a chunk of metal versus, hey, I can fix your truck for you, fix your boat, whatever it is, it's probably going to be more value when you trade off that way. That's just kind of the doomsday scenario that a lot of gold investors tend to say, or reason why they invest in it. If you like gold, go for it. I just personally don't hold any myself, but we do invest in gold. And it has done really well last year. Number 20, we got real estate crowdfunding. So pool money into investment projects. I don't really know how you can get into this, at least in a retirement account per se. Could be a good deal. I don't know enough to speak on that one there. Now let's get into the tax advantage strategies out there. So number 21, Roth IRA conversions. I talk about this for a lot. It's one of the ones I use the most with clients. It's one that applies most often to Washington State employees. Also has one of the biggest long-term tax benefits. Roth IRA conversion is something that I visit clients every single year. Even if we decide it's not a good idea, we always want to revisit and make the conscious decision to do it or not do it, because it's just so powerful. So Roth IRA conversions are something that everyone should be considering every single year, even before retirement. If you have any money in an account that's eligible to be converted, like the deferred comp, it is something that you should consider. Number 22, health savings accounts or HSAs. So some state employees have these. Other ones are probably more familiar with the term VEBA, or the Voluntary Employee Benefits Account. They're not technically HSAs. They're more of a health reimbursement account, but they operate in the same, they give you the same triple tax advantages, right? So pre-tax going in, so I put money in without paying taxes, gross tax-free, comes out tax-free as long as I use it for any kind of healthcare needs. Probably one of the most efficient tax vehicles you can use. If I had to choose between funding an HSA or funding a Roth IRA, I would fund an HSA over that. It has more tax advantages to it. And after 65, if I don't want to use it for any healthcare, the money can still come out to be spent on whatever I want. Keep in mind, though, that if I do spend on something other than healthcare after 65, I still have to pay taxes, but there's no penalties anymore for spending on something other than healthcare. And chances are you're probably going to use your HSAs at some point for some type of healthcare. So it's a really good vehicle to have. This is why I often recommend people put money into VEBA rather than cashing out their sick leaves, because you get that money not only tax-free, you also get it to grow over time. So it can be a big help, especially if you're thinking of retiring early. Number 23, 403B contributions. So 403B is just like a 401k plan or like a deferred comp. They're eligible for typically nonprofit institutions. Washington State employees have access to this in addition to deferred comp. There's separate tax codes. Rules are a little bit different, but essentially you're able to fund this independently of your deferred compensation plan. So it's just another vehicle you can use. You can do it on a pre-tax basis. If your district allows it, you can also do it towards Roth. The big thing here is 403Bs are not a state account. They're managed by private companies. Your district decides what private companies are allowed and not allowed. So you have to kind of do your own research to pick which one you want to go with. There are two different types. One are annuity based. So you put money in, money's going to be locked up for a period of time. If you took your money out before that time period's over, there's penalties that they assess you. The other ones are 403B7s, or they're mutual fund based. They're not annuities. They're not done with a life insurance company typically. So the money can be moved to other institutions without any kind of surrender penalty. So two different types. You want to make sure you look at the different types and look really good at the fee structures in them before dumping into one. They're a pain to get out of and transfer. So you want to make sure you do the work ahead of time, which so in the long run it'll be a lot easier to manage and cause a lot less headaches. Number 24, 529 alternatives. I don't know why it says alternatives here. We'll just go over 529. So I know a lot of people that have 529s. Historically, I've not really been a big fan of them. They're savings accounts for college. Washington doesn't have a state tax, so there's no added tax advantage to using a 529 plan. It grows and can be used for college, just like a Roth IRA would. So Washington, it's not as tax advantageous as other states for the use of them. Up until recently, the 529s had to be used for healthcare. If your kid ended up not going to school or didn't use all the funds, that money was kind of just stuck there. And there's a new rule that as long as the account's been open and it meets, I think it's a 15-year eligibility window, you can actually move that into a Roth IRA. It's not necessarily a Roth conversion because it's treated like a Roth contribution. You can only move a certain portion over each year. That's one option there. Again, I'm not a big fan of it. I don't personally fund these for my kids. I use another vehicle, which they probably are going to talk about, but actually just use permanent life insurance designed for maximum cash flow. So that way I'm funding money into this fund. It's, protected from all market losses, only goes up. I can borrow against it. So I can take a loan out. The loan comes out tax free. And even though I have a loan, the loan comes from the death benefit, not the cash value. So even though we have an outstanding loan, the cash that's still in there is still earning interest. Oftentimes the interest that it's earning is going to offset the interest charge on the loan. So the cash value still increases. You can always pay the loan back at any point and pull money out again in the future. So if they want to use it for school, paid it back, then they decide, hey, they want to use that money to buy a car, down payment on a home, something like that, they have the ability to go in and out of. So I just think it's a more holistic vehicle that I personally like. It's not right for everybody. You got to understand how to use it. And there's people that will argue that you just put money into the market and do better. Maybe Sue, in terms of like total returns, but once that money comes out and spent, it's done. Give that dollar more than one job. So that's why I use life insurance instead of 529s personally. Strategy number 25 here. We're now switching to income. So we got bond ladders, covered call writing, rental properties, preferred stocks. Most people aren't going to use any of these other than maybe rental properties is probably the most common one on this list. Bond ladders, I really don't like. Basically, you're buying individual bonds, trying to wait for the maturity date. So when one matures, you can buy another one with it, repeat the interest on. Bonds haven't been paying as much lately. Bonds is just a fancy name for debt. So when companies try to raise cash, they issue bonds. And so it's debt on their books and they pay an interest rate for essentially loaning them the money. Interest rates haven't been all that great lately on these. So while I think bonds have a place in the portfolio, building a bond ladder in terms of income, I don't really like that play. They're not exactly safe either. They can still take a dive. They've lost money a decent amount the last few years. So I'm not a big fan of bond ladders. I don't use them at all. Covered calls, if you're options. I don't know anyone that trades options, at least any state employees. I know if you get good at them, you make a lot of money. I don't mess with options, so we're not even going to go over that. 27 rental properties. Again, this is probably the most common one. People like getting into rental properties for their monthly income. It does take a decent amount of investment plus managing it, so it can be a big time suck as well. But overall, in the long term, it's not bad. You got another property that grows in value historically, plus it generates income. So it's not a bad asset to hold. If you want to get into rentals because you want the income, just consider that fact that it does take, a significant portion to get it invested. It may take some time to make your money back. You got to deal with people, management companies. So there may be more stress than it's worth. So you kind of have to see, is the extra potential income, worth the investment? I know a lot of my older clients are actually getting out of the rentals. They're starting to sell them off because it just gets too much. While the income's nice, at that point, it's just not worth dealing with the hassle anymore. They want to enjoy a less stressful retirement, and they're actually reducing the amount of properties they have. All right, so I had a client that had 6, before she retired. Now she's down to 2. So she's slowly been selling off her properties. It was just too much hassle. So rental properties, right for some people, not right for everybody. I actually have a different cash flow vehicle in the crypto space that I've been testing out. It's the same but different. We're not actually owning physical properties, but it doesn't take a lot to get started and generates monthly income right off the bat. So I'm still testing it out. And when I get more information and have my results tracked, I'll present that later. Option 28, preferred stock. So preferred stock is just a classification, basically just pays out higher dividends. I already mentioned we're not really into the whole dividend scheme. Don't know anyone that has any preferred stock. If you want to get in that realm, I guess you could, but it's just one of the strategies that isn't real realistic. I don't know a lot of people that would actually use them. The everyday folk, having preferred stock and we're getting, higher dividend payments. Not realistic, not something you need to worry about or study up on. All right, now let's go over their advanced strategies. Tax loss harvesting, absolutely. Charitable giving, yep. Hedge and inheritance planning. All right, these are all good ones. These are ones that we talk about every single year with our clients. So tax loss harvesting only matters if you have money in an investment account. So anything not in a retirement account. So not Plan 3, 403B, IRA, not Roth IRA, just straight up I put money in an investment account. There are no tax advantages. There's no fancy terms. It's just brokerage account. The account's in my name. So anytime we have a loss on record, we can use that loss to offset. So for example, if I bought one stock and let's say it went up $1,000 and I sold it. That's $1,000 gain that I have. But let's say I bought another stock and it lost $2,000. I could sell it for that $2,000 loss. They'll take the $1,000 that I made and offset it by the $2,000. Now that shows a negative $1,000 of capital gains on my tax forms. Now I can use that negative $10,000 to offset other income. So if I made $100,000 that year, I would take $100,000 minus that $1,000. Now it's down to $99,000. So now I get taxed on $99,000, not the full $100,000. So it's a way for you to offset gains from other assets as well as your normal income through that. Now, obviously, you don't want to invest in things that lose on purpose, but when they do go down, it is a solution you could use to generate and offset potential tax implications elsewhere. Number 30, we're going into charitable giving. So charitable giving is basically when you donate money to charity, and some people will do cash and stuff, which can work with the standard deduction as high as it is. A lot of people aren't really getting any benefit unless you're giving more than standard deduction or more than $30,000 in most cases. You're not going to see too much of a value here, but there are certain ways to do it. So I'm actually in the midst of helping out a client do QCD, which is Qualified Charitable Distribution. So in his IRA, because he just turned 73, we can actually take money from the IRA, which is pre-tax, and give it to a charitable organization. In this instance, it's the Church of Latter-day Saints. He wants to give money from the IRA rather than his bank account to them. Now, when he does it, he's pulling money out of a pre-tax asset and giving it to another nonprofit institution. So what this does for him is, because it comes from a pre-tax asset and goes to charity, it's non-taxable to him, so he doesn't pay taxes on it. The charity that gets it, because they're a nonprofit, they don't pay taxes on it. So it allows someone to give more money to the charitable organization. Right. Whereas we're currently, if he wanted to do $1,000 from his income, he would get his pension, he would have to pay taxes on it, and then he'd have to turn around and give the $1,000 after taxes. So you can essentially give more money when you give from a pre-tax source. Instead of giving a portion to the IRS, that portion essentially goes to the nonprofit, right? So in other words, if I want to do $1,000 after tax to a charity, really that means it's the $1,200 of income. It takes me $1,200 to net the $1,000 just to give to the church. So I gave $1,000 and the church got $1,000. Whereas if I, from the IRA, I could just take the $1,000 out and give it to the church. So I saved that extra $200 in taxes. I cut the IRS kind of out of the picture here. Now, in this individual case, we're actually also donating his required minimum distribution. So at 73, all pre-tax accounts are required to start, you have to start pulling out a certain amount to withdraw his income so they can tax you on it. They let you defer taxes so long. So at 73, so most people are going to be age 75. Whenever your RMD age hits, you're going to have this requirement, but you can actually donate the RMD to the charitable organization. It gives you no tax impact. It meets the requirement distribution standard, so it counts as pulling it out, and the church gets more money. So if you get to that point where you don't really need the money, you don't want to pay the taxes, and you're already giving to a charity, it's a good solution. If you're not really giving money to charity and that's something you really care about, you're not going to come out ahead. The donation you give always results in 100% loss to you. That money is being given away, and any kind of tax benefit that creates is not enough to offset all the money that you just gave away. So the charitable giving is a great solution if you're already doing it. If you're not, there's no way it's going to work on your favor just to start doing it all of a sudden. So it's something you have to believe in before applying. All right, 31, IRA and pension inheritance, structuring accounts for beneficiaries to minimize their tax burden. So inheritance planning, it's not so much the pension per se. So that's going to be like electing your beneficiary on that. So picking your survivorship, super important. That is something that I always recommend some people look at. A lot of people are like, oh, I'm just going to take the full amount because my spouse doesn't need it. They haven't done much thinking long term as far as how much of a loss that is. Are they actually going to be okay if they stop receiving $2,000 per month? Do you actually have enough saved, to offset that loss? So just something to think about before choosing survivorship. But the IRA is really where more of the inheritance planning comes in. So it's choosing, does the IRA actually go to the beneficiaries or does it go to the trust, which my kids are, the beneficiaries of? So it's just a way to structure it so you can avoid probate. You can have more control of things. So it just allows you, better control and more protections if you have the proper planning in place. All right, moving on to retirement specific strategies. We got income buckets here. I talk about income buckets a lot. Short term, I don't really use buckets like this. I guess you could. I talk about the 3 bucket solution where I have 2 years of income on hand in cash, 3 years in some type of bond fund. That gives me 5 years of cash without worrying about big market corrections. Everything else I have invested in the market, it's taking on more risk. And then I'm just going to use the gains that larger bucket creates to refill the other buckets. So those are the buckets I use. I guess you consider it short, medium, long. I call them cash, income, and growth. For the most part, same thing. Then we have guardrails. Guardrails is something I use a lot too. So guardrails just gives us essentially a ceiling and a floor. So if we're currently taking out, let's say $3,000 a month from our portfolio, the guardrails is going to tell us that if our portfolio hits a certain threshold, we have to reduce our spending by X amount. So in my case, I usually use 10%. So for example, if our $1 million account drops and now we're sitting at $900,000, maybe we have to reduce income from $3,000 per month down to $2,700, for example. And the same way works the other way. If our account goes up and hits 1.2 million, and we don't want it to keep growing necessarily, we want to enjoy retirement, then we're going to start spending more. Hey, you're approved to start spending $3,300 per month. So that's an example of how guardrails work. Sequence returns is huge, especially for early retirement. You can average 8% per year over 30 years, but if your first 5-6 years are all negative or very low returns in beginning retirement, it'll absolutely wipe you out. So the beginning years are the most critical, and a few negative years, especially early retirement, or all in a row, can really wipe out somebody. So it's not just how much I'm getting over the long run, it's what order they come into that matters a lot. 35, reverse mortgages. Love reverse mortgages. It essentially allows people over age 62 to access equity in their home without the risk or without the worry of having to repay it back. It just gives you more access to it. It's not going to get foreclosed upon as long as you live in the home, pay your taxes, keep it insured. So basically you do everything you currently do when you still had a mortgage on the home. But what it does is gives you access to the equity, so you can use it for retirement income. You can use it to offset any kind of big withdrawal. You use it to purchase cars, second properties. These cases endless. A lot of our clients are using it now for long-term care as like a backup. So if they don't want to buy insurance because they're not sure they'll use it, they have a reverse mortgage on hand. So if and when the time comes, they'll tap into it. If they never need it, as long as you're not drawing down on it, there's no annual cost to have it. There's initial cost to get it set up, but once it's there, it's just another asset that also grows on a guaranteed basis every single year. So no matter what the housing market does, reverse mortgages has a clause in it that the line of credit grows each and every year, and it can't be closed or frozen by the banks. So first mortgages are superior to home equity line of credits in that way. All right, got our last ones here. Strategy number 36, dollar cost averaging, basically investing every single month, regardless of what the market's doing. So as the market's going up, you're buying on the way up, and when it comes down, you're buying on the way down. Historically, this has been one of the best strategies to do, is just keep buying on it. Number 37, value investing. This is more like Warren Buffett style, where he does a lot of research, tries to find undervalued stocks that he truly believes in, got strong fundamentals, he buys into it, and then kind of forgets about them and waits for long-term growth. That's why he owns things like Apple and Coca-Cola. That's value investing. A lot of people don't have the time, patience, or the knowledge to figure out what's currently undervalued, so it's really hard to do. Dollar cost average is going to be better for most people. Momentum and thematic, they're going to be similar. And just trying to find trends like renewable energy. A lot of people are talking about AI right now. Trying to find what people are talking about in the media, what's a currently growing sector, and investing in there. So thematic is just going with that. Momentum is seeing what's going, what's rising, what's selling, and follow them. So if AI stocks are rising, you start buying those up. If the energy sector is currently falling, you would short and sell it right down. So whatever's rising or falling rapidly, you're going in and out of those. Right. So that's momentum. I call it trend following, and I have some of my money doing this type of thing. It does well. For the most part, a lot of it's flat. And then when you have the big moves, when you see the count either take off in one direction or the other, it's not the most exciting thing for the most part. Barbell, I never really heard of until it's spattered here. From what it sounds like though, is that you have ultra safe assets like cash and high reward things, I guess like a penny stock, whereas you're either in one or the other. Just like the barbell, there's nothing in the middle. We're only stocks. We're either all safe and we have super risky play. I wouldn't really recommend it unless it's with a little bit of money. You could go it that way. But yeah, so that's the 40 investment strategies that you guys could utilize. If you have questions or want me to go in depth on any one of these, feel free to drop them in the comments below. And until next time, remember that your future depends on what you do today.